be advised that this recorded webinar has been edited from its original format, which may have included a product demo. To set up a live demo or to request more information, please complete the form to the right. Or if you are currently not on CSE Global, there is a link to the website in the description of this video. Thank you.
Hello everyone, and welcome to today's webinar, Global Fund Finance Liquidity Solutions for Private Market Fund Managers. My name is Christy DeMeo-Ziegler, and I will be your host for today from the CSE webinar team. We're very fortunate to have some amazing speakers who will be sharing their insight and expertise with us. Jonathan Spergel, Managing Director of Cash and Liquidity Public Markets at Hazeltree. Stephen Quinn, Senior Managing Director at 17 Capital. James Rock-Paring, Head of Fund Finance Advisory at CSC. And our moderator, Marshall Saffer, Managing Director and Global Head of Funds Service Line at CSC. Without further ado, I'd like to pass on to our speakers.
Thank you very much, Christy. My name is Jonathan Spergel. I'm with Hazeltree. I've got about 35 years of experience within the banking and treasury sector, both on the private markets and the public markets side as well.
Hi, Stephen Quinn at 17 Capital. We are a dedicated provider of NAV finance across preferred equity and NAV loans. I've been with 17 Capital 4.5 years. The prior 20 years in some form of private equity financing, most recently as Global Head of Financial Sponsors at Lloyds Banking Group with responsibility for their fund finance business.
Thank you. I'm James Rock-Paring. I head up the Fund Finance Advisory business here at CSE. We advise private market funds on the raising of fund finance facilities across subscription line and NAV financing. Previous to CSE, I was at Lloyds Banking Group in the fund finance team, and prior to that, about 15 years experience in the leverage finance market.
And I'm Marshall Saffer. I'm going to be the moderator for today's panel. And my background is about 30 years of working in the hedge fund and the private market space, providing solutions and software to this industry segment. So in terms of today's agenda, what we'll be discussing today is a general overview of the fund finance landscape in terms of providers, the ecosystem, some of the challenges, the market. We're going to talk about NAV market dynamics. We're going to talk about treasury and cash management, fund financing market and the roles that advisors play in the space, common issues and bottlenecks that the group is seeing, and the evolution of the fund financing market. So what I'd really be interested in, so what we're seeing in the private market fund space has definitely become a very interesting market globally, right? We're seeing rapidly changing macroeconomic factors such as what inflation's doing and the interest rate changes. We're seeing a very muted exit environment and a consequential slowdown in fundraising and deal activity. And our thoughts are that this requires a very deep understanding of the fund financing market and the relevant providers of liquidity to stay ahead, as well as the best practices associated with this market in general. So I'd really be interested to hear the panel's perspective on what the main liquidity concerns that private fund managers face in the current market. Jonathan, perhaps we start with you. What are your thoughts around what you're seeing in the marketplace and any insights you could provide?
Great, thanks, Marshall. A pleasure to join you today. So our view is a little different than I think some of the other members of this team. We're in the technology side, and we cover a broad swath of alternative managers, both public and private. But today we'll focus really on the private side and what the concerns are for our clients. So, back 2 years ago when interest rates started to increase, we saw some of those dynamics change of how private markets entities behave. And then this March, specifically with the stresses in the banking segment, we saw some new dynamics kind of show up. And what I mean by that is the ability for clients and private funds to understand where their liquidity is. not so much focused on the fund financing, although that's extremely important to them and it's a lifeline of what they do. What they really wanted to understand in a very cohesive, quick manner is where my exposures are, where is my liquidity, how do I manage that, how do I understand the impacts it has. It used to be, and I've learned this from my hedge fund days, I'm sure you as well, Marshall, back in 2008, liquidity is a paramount concern. How can I access liquidity on a moment's notice when I need to have it for, if I'm closing a deal or an investment, or need to make a payment? How do I understand where my liquidity is? And previous to this March, we saw many of our clients use bank portals or technology where they needed to be able to aggregate their information, and they did it on a sporadic basis. Now we've seen the market really change, that where folks need to understand where the liquidity is coming from and how can they access it. Not understanding where their liquidity is can really put them behind the 8 ball as they do their daily activities as it relates to treasury and cash management, which fund financing is, of course, a very important part of that. But that dynamic has changed dramatically. So I'll leave it at that. I know we're going to get into probably a little deeper exercise on treasury management. Happy to pick it up there.
Okay, thank you. Stephen, what's your take? What are you seeing? Or what are your thoughts?
Certainly one point, Marshall, I'd pick up on is that was mentioned as the difficult exit environment, which we have seen certainly for 12 months, probably 18 months. I'm not convinced we're at the end of that particular challenging tunnel just yet. And I suppose from our perspective, what we're saying is that now managers are holding these portfolio companies, these assets for longer. But that then has an impact, elsewhere. It makes the fundraising environment very challenging. Again, we've seen that going hand in hand with the difficult exit environment. LPs are not getting the level of liquidity that they have become accustomed to over the last 10 to 12 years, where they were actually the net beneficiaries of capital over and above what they were drawing. We see it at the management company level, with ambitions to scale and diversify and grow, but the liquidity that they would be generating either through AUM or through sales, etc., isn't coming. So it's one issue, but it permeates the whole market. And again, on new deal doing is tough also, particularly in terms of platforms. So I think if you look at 2022, around about 60% of deal activity was buy and build. And that makes sense, because I'm going to hold the assets for longer. I want to invest in them. I may have exhausted my investor capital. So from a NAV perspective, that ability to generate further growth capital is a big requirement of the industry. And then probably the final point is really around about generating liquidity for your LPs, or if you like, finding what I would like to call a liquidity alternative. Because you're going to have to hold these assets for longer. You want to create some kind of liquidity event for your investor. For a lot of investors, that is highly appreciated liquidity. But it also de-risks the investors as well. And again, it creates a runway, if you like, a platform to hold these assets and grow them for longer. So certainly the challenges in the exit environment are really causing quality managers to look at things a bit differently and look at their alternatives a bit differently.
Interesting. Okay. And then James, what are your thoughts? We might as well round up this question from you.
Yeah. Well, Stephen's spoken a bit about the NAV market. So just to round on the fund finance market is subline in NAV. So from a subscription line market, sometimes called capital call line markets, that market is big. It's about $700 billion globally, right, in the US and Europe. So, if you look at the number of banks in the market, there's over 100. If you more recently, more so in the US, is banks need to hold more capital now against these loans, coupled with the fall of SVB, Signature Bank, First Republic, that took about 40 billion of that lending out of the market, right? So As a result of that and the general economic environment, banks are much more selective and slightly restrictive in terms of balance sheets. So there's a slight funding gap and a lack of supply of subscription line facilities to private market funds. So if you're a first-time fund, it's extremely difficult to find a facility. Mid-markets still reasonably difficult, and if you're a larger manager, it's not as easy anymore. And the bank's ticket sizes are smaller, so you're having to put more banks to a club or a syndicate, but it's still quite hard and scarce to find liquidity. Banks being selective, they're not just looking at the lending, they're asking for deposits, they're asking for more ancillary income, FX, banking, etc., M&A mandates. So it's a much more difficult market, a big lack of supply in the subscription line market. And I suppose a small mitigant to that is that your interest rates are up, so maybe there's a pullback in the size of the lines because obviously it's more expensive. I mean, Euribor, for example, used to be negative not that long ago. It's quite materially higher now, same in the US with the cost of funds. So, and then fundraising is slowed slightly. So that's a slight mitigant to the demand side. But once fundraising comes back, interest rates hopefully subdued, this tool, which is used by more than 80% of managers, you'd expect the demand or the supply gap to even widen. So I would end by saying that there's a small number of entrants coming in, maybe from the institutional side, which might help to fill the gap. But that we can talk about that a bit further on in the webinar.
Okay, that was extremely helpful for me. So let's move on to the next question. So there's been a lot of talk, and Stephen mentioned it, James, and you've mentioned it, is this concept of the NAV market, right, and NAV financing. So can we first start off with, for people that might not be 100% familiar with the concept, can we start off with a definition of NAV financing, just so we can all be making sure we're talking about the same thing? And then if we can discuss why managers are now using these facilities and what's the broad range of facility types that are available that can be leveraged. Is that okay? Stephen, could you kind of pick up from here?
Yeah, thanks, Mark. I'll kick off. You're certainly right that there's probably been more discussion and written pieces about NAV finance in the last 3 years than the previous 15, albeit that it has actually been around. So maybe going on to the net asset value in terms of the fund finance landscape. In simplistic terms, on the subline, the capital call, which James has summarized very well, the recourse is to the institutional investors that invest in that private equity fund. In NAV finance, your collateral pool are the assets that the manager holds, for example, and that's at the most basic level. And I'll try and maybe just expand on that a little bit. In the interest of time, I won't try and cover the whole universe because that would end up being a little bit of a monopoly of everyone's time. But maybe I'll cover a couple of pertinent points as to why I think you're seeing that growth. I think the first thing really is the relevance across private equity stakeholders, and that might be private equity funds, that might be the managers of private equity funds, and by that I mean the management companies themselves, and also investors in private equity. So you've got this hugely diverse audience for which NAV finance can be very, very relevant. There'll be specific drivers for each. The use case for NAV finance for each of those will be a bit different, and NAV finance can be tailored, to that. And related to that is that there's a very broad church of structures, within that NAV finance, universe. The structures, the features, the benefits, and that could be, certainly for us, that ranges from, the very flexible, potentially higher LTV preferred equity type offering, which becomes, particularly relevant, we've noticed over the last few years at the management company for growth and succession planning, etc., into the lower cost NAV loans, which is more of a debt-like kind of characteristic. And then again, maybe when I think about growth, I think there's one other pertinent point is around just, and I think we've picked up on this, is just the general lack of alternatives in the market. And when that happens, managers need to find new ways to finance their growth and the liquidity
Right.
needs. Private equity managers are not very good at sitting on their hands and doing nothing. And really what you've seen, not just over the last 3 or 4 years, but perhaps an acceleration, is that NAV finance has really come to the fore as one of those alternatives, to such an extent where it's actually now probably quite embedded within the if you like, the financial toolkit for managers.
Interesting. Okay. James, what are your thoughts? I mean, this is what you do for a living, right? In terms of helping people and assisting them in finding the partners.
Yeah, so I mean, to add on to what Stephen said, so just to summarize, NAV lines are either money back to investors, or you're investing in the fund, in the portfolio, right? It could be used by the fund. It could also be used by the general partner as well. So I think maybe it'd be useful to add from my side is, when I look at it, because I face off back into the market, right? So I will have a list of what I would call NAV banks and NAV credit funds, effectively. So the NAV lending market is, if we talk about the subline market, it's, there's 100 providers of subline. I think on the NAV side, it's growing and could even be bigger or getting bigger. So, but what I would say is that in terms of the number of products available, and Stephen touched on it there, was if you get more to the NAV requirements where there's a lower LTV or there's a more diversification in the portfolio of NAV, then you're getting to the banking market and your margins are lower and the lower risk product, and that's more conservative, right? And then as you move up the capital structure, you get to a slightly higher LTV, maybe more concentrated portfolio, and that's when it morphs from a bank lend into a credit fund lend. And the further up you go, the capital structure, where you maybe want more flexibility, if you don't want it to be a debt-like product and becomes more pref with no term and no security, the margin creeps up, and to get to the point where maybe a GP wants to use what I would call maybe structured equity, where it's there's no actual fixed interest or coupon, and it acts in a pure waterfall, but it's not equity, it's cheaper equity. So there's a myriad of products and tools, and Stephen mentioned as well, it's not just an off-the-shelf product. It's very tailored to the fund. So when you go out to the market, it's very hard to go out with a generic ask of these are the terms I want. A lot of it's iterative, and also the structure and the pricing can vary between lenders, right? And sometimes it can be a crossover between is it a credit fund NAV deal or is it a bank deal, depending on if you're where you are on the LTV and the concentration. So I would just. Yeah, I think I would say that I would probably leave it at that, because as Stephen said, this is a topic you could run a whole webinar on. But yeah, there's a lot of tools. There's a lot of lenders in this market.
Okay. This is the first time I've heard James saying that he actually speaks to another credit fund lender.
Right.
This is news to me, Marshall.
That's great.
I was going to tell you afterwards, Stephen.
Well, let's change gears a little bit. Now that we kind of defined it and we've described the type of applications for it and the type of instruments and what can be leveraged, I'd like to kind of talk about effective treasury and cash management and some of the concepts around how that contribute to enhancing the overall financial stability or the given performance of the fund, or the concept as the treasurer and the treasury functions actually adding alpha to the performance. And how technology might be able to play a role in that. So, Jonathan, I think this kind of fits into your sweet spot. So I'm going to ask you the question, or respond to the question of how do you think that technology and best practices comes into play? And if you could give some examples, that would be great.
Sure. So yeah, the market has evolved in this space over my career, to say the very least. But let's go back to what are the main tenets of a proper treasury management structure, right? So, and I'm talking from a treasurer's perspective, not from the investment side of an organization. It's preservation of principal, it's liquidity and performance. And every time I talk to a treasurer about those three principles, I always ask them, what's the most important? You can only pick one, and they always start with performance. I need performance, until they don't have liquidity. and then liquidity becomes the most important part of their life, and we've seen that multiple times. So it's a very interesting question, and as treasurers start thinking about their platform and how they're going to manage their portfolio, so to speak, to be able to work within their firm, they need to define what the most important premise is within that. And in order to do that, you have to understand where your liquidity sources are. And so from a private markets perspective, clients have cash reserves that they keep in a bank. Which bank, how many banks, really, really important. Understanding what those risks are within that organization where they decide to keep those assets, and then where can they bring on liquidity and how quickly can they do that as well. Capital calls, the credit lines that James and Stephen just spoke about, and how can I put that into a platform where I can see that on a moment's notice, in a stressful situation or in just normal course of business. And so, there is technology. We do that at Hazeltree to be able to bring that all into a platform, bring it into a solution that every morning you wake up, you can see where those liquidity sources are, and then you can act upon them. So you don't want to spend a tremendous amount of time, which currently is occurring or evolving within the private markets landscape, where you're putting that information together. You go into your bank platform, see my balances. I find out where my capital call capacity is, where my lines are, which banks, what's the rates on the various features I have. And then how do I actually execute on that, and when do I actually get the liquidity? So we put together within Hazeltree an ability to be able to pull that all together within your fingertips to be able to execute on that and really figure out, from a solution, from a treasurer's perspective, of where my liquidity is, where my assets are, where are the arrows I can potentially shoot, and then of course making sure that performance. Do I want to pull on that capital call? Do I want to pull on the credit line? Which is the most advantageous, depending upon the risk and return associated with those types of things that I'm actively working on. And so, whether you're a small fund or a very large fund, these become quite complicated very, very quickly. And so hopefully by using technology, anyone's technology, be able to execute on that, provide the transparency in a almost real-time look and feel is really, really important. You can't do it once a week anymore, which we've seen back in March of this year. Some clients were pulling balances from banks on a monthly basis or weekly basis. We see it really on a daily and sometimes intraday basis. They need to understand where their risks are and where their liquidity is going to come from. So we could talk about that part for hours, but it kind of reminds me of, back in 2008, the hedge fund community went through exactly the same issues. Now it seems like the private markets community, which has had tremendous growth over the past few years, are grappling with the same exact issues.
Do you think that we're seeing a move to a dedicated treasury group within the large PE and private market funds? I know, right, it's kind of been I'm seeing a transition, but I'm wondering about your take. And do you see outsourcing playing into this at all?
Absolutely. So we do see that, where probably 3 years ago, the treasury function within a private market shop was, a guy who did payments and things like that. I don't want to minimize that, but it was a treasury operation or an operational part of the organization. Now they're hiring and focusing on dedicated treasury staff, and then looking at how do I do this real time throughout the day. And so from that outsourced solution, using a technology solution, do I want to hire that group, or do I want to use someone that can help us make that happen in a very efficient manner with best practices already built into their processes to be able to do that? And so we've seen a lot of that. We've seen treasury become front and center. Returns are really, really important. Costs of those returns are really important, and risk associated with that is really important. And so having that outsourced solution that can kind of bring that all together, using terrific technology, of course, what we have, but we're not an outsourced solution like you guys are, to be able to do that in a very efficient, repeatable way every single day. So there are no surprises. The worst thing is you don't want to get that call from the CFO, the managing partner, saying, what's going on with our liquidity? Do we have enough? Do we know where it is? Where our risks are? What's my bank health? Because a bank can have a line to you, but if that bank is teetering, that line's not going to be of use to you, and you're going to have to find another source of liquidity somewhere down the line. And so we've seen that as well, unfortunately.
Okay. So let's change over to the fund financing advisor role. James, do you want to kind of give us an overview about where that fits into the whole ecosystem and some thoughts around that?
Sure. Yeah, just to put it in perspective, if you look at the sort of private market or private equity assets under management, say 5 years ago, it was 2017, I think it was like 7.6 trillion. It's now 14 trillion. So it's an 80% increase. So, and as a result of that, you have the fund finance facilities, which have obviously grown in line. So subscription line and NAV. And if you look just at the subline market, I think it's grown from 400 billion to 750 billion, right? So you've got a large increase in the assets under management, a large increase in the number of facilities. And then on the flip side, on the supply side, I mentioned previously, and Stephen mentioned as well, is that there's a marked increase in the number of lenders in the market, whether it be subline or NAV, right? So as a result of that, the advisor role has sort of grown materially in the last few years, and it's effectively an intermediary between the borrowers and the lenders. And if you had to put it in sort of into three stages, I would say the role that they provide is to source liquidity, right? So it's not only sourcing liquidity from working out which lenders in the market are available to provide the financing. Lenders have different appetites. They have, some are niche, some are not niche. It's quite a broad market. So it's sourcing the liquidity, also giving a lens into the market and update. So I think that's the first step. The second step is running a competitive process with a proportionate number of lenders to seek terms. And then what the end of that sort of stage would be to pull all the terms together, all the term sheets together, and do a compare and a contrast on the grid to work out who to negotiate with, who to push back on pricing, which key commercial terms to do that with. So, and at that point, the advisor would work out whether it's, depending on the size of the deal, whether it's a bilateral or whether it's a club or a syndicate of banks or credit funds, depending on whether it's NAV, who to go with. And then the third stage where they have a role is to project manage and advise through the execution stage. And really, they sit between, obviously, the borrower, the lender. You'll have legal advisors, both sides, for the sponsor, for the lender, but effectively they sit in the middle. They make sure the process gets done. They help with the bank's credit processes. They really deal with some of the most key commercial terms or bottlenecks that may happen in the execution phase, and just make sure that there's a successful outcome. And this is across multiple products. And I'd say the last thing to say on that is that it does help with bandwidth. So it depends on the size of the team that the sponsor has. If they have a big capital markets team, the need for an advisor is less, albeit sometimes they tend to outsource a smaller line or a smaller financing. But generally speaking, sizable mid-market managers all the way down to small managers, first-time funds, is generally a role, because it's pretty time-consuming one is to go and find their lenders and source liquidity, and also to obviously put these facilities in place.
So the ideal client is someone that has not staffed this themselves or is having capacity issues. I assume you add some efficiency to the process as well.
Yeah, I mean, it's if you had to say the sweet spot, it's actually quite broad. So it could be a manager who hasn't done it before, or they just don't have the time, or it could be a large manager that, for example, who, if you look at it from a subscription line perspective, it's a cycle, right? They tend to only go out every couple of years, and also, if you've got some large banks in there, they're only with 2 or 3 from the last fund. It means they haven't gone to market for 2 years. So and if there's specific financing needs, especially on the NAV front, there's probably a slight bigger increase in the number of advisors on the NAV front, right? And how often, it's not like a NAV deal is done every single day. It's more needs driven. So the size of the manager does have a bearing on it, but I wouldn't say it's the extremely large sponsors. It's more upper mid-market, all the way down to a smaller manager, I'd say, is the sweet spot.
Okay. And I'm just kind of curiosity in terms of the number of lines that your average PE firm would be utilizing, right? Is it one provider? Do they use multiple providers? I think some insights around that might be interesting.
Yeah, so look, if it's a smaller manager, then it's a bilateral deal, and the bank could be providing the subscription line facility, for example, that could be 40 million, 50 million, up to say 100 million. If you've got a 600 to 800 million line, you might have 2 or 3, 4 banks in that. And obviously, if you get to the very large clients, there's a large syndicate. It could be up to 15 banks in the syndicate for subline. On the NAV front, I mean, maybe Stephen could talk to this one. I mean, it could be a bilateral, but if talking about a very large manager, it might need a few banks to be providing a NAV line. But Stephen, it's interesting to see you on the NAV front.
Yeah, both of those scenarios, James, where probably probably the majority of our investments are on a bilateral basis, but you'll definitely see anything between small club deals to larger facilities, just either necessitating more lenders or where the manager is keen to maintain a number of relationships within that facility. And again, it's the trade-off, isn't it, between obviously getting the required capacity for the NAV facility, but managing complexity in terms of the number of parties that you're dealing with. So it's not one size fits all, but it's really that spectrum.
From a bank perspective, if it's a large NAV deal from a banking perspective, there's probably more chance there'll be a club deal from that perspective. But if it's a 100 million, 200 million, you may find that one single bank lender may be able to do that.
Okay, that's very helpful. Next question then for the team is, so from the borrower's perspective, what are the common issues or bottlenecks involved with putting a capital call line in place? And how about NAV facilities? James, why don't you pick that one up, since it starts with the fund finance?
Sure. So look, I think from a sort of subline, I'll touch on the subline. Stephen can talk about the NAV. Just really quickly, the biggest bottleneck or issue now is obviously we've already touched on, and that's the whole topic is liquidity. The size of the lines have reduced because ticket sizes are smaller, so you need to definitely need to find more banks. The focus now is stability of a lender because of what's happened to a few of the banks. So borrowers are doing diligence on who their lender is from an operational perspective. Another issue or bottleneck could be subline lenders prefer institutional investor base, right? So they tend to discount or exclude high net worth individuals or certain family offices from the borrowing base. So a issue could be if you've got a very large percentage of family office or high net worth, more difficult to put a line in place. First time funds is very difficult. The IRR benefit of a capital call line is it's effectively a working capital tool, but you get it can be accretive to IRR. The cost of financing is now increased, so it's not at sort of the hurdle rates, but it's getting to the point where managers are focused on it and to say, well, is it costing me to put the line in place? I don't think we've hit that point yet, but it may not be as IRR accretive as it's been in the past. And lenders, it just takes longer to put a facility in place now because lenders are doing more diligence on the investors, and they're doing more general credit diligence on the performance of the funds. And banks are just generally taking longer to put these lines in place.
Stephen, how about you on the NAV side? What do you see?
Yeah, probably 2 points. There's probably 10, but I'll save you all with 10 points. I think there's two main ones. One is the art of the possible. I talked earlier about, and James has mentioned that the flexibility, the types of situations that can be relevant from, and whilst it's a space that's becoming increasingly familiar, it's not as ubiquitous as, for example, on the capital call subscription line market, albeit that adoption we are seeing growing. But again, that if you think about the use cases, from a management company, how do I use NAV finance to grow and diversify the platform? How do I manage succession planning? If I'm an investor in private equity, is NAV finance the alternative to a secondary sale if pricing in that market isn't attractive? For private equity funds, what's the optionality to create growth and liquidity when so many of the other alternatives isn't available? So we are seeing that awareness, that adoption increasing, whether that's the way we've seen with sublines, continuation vehicles, and fund-to-fund transfers, etc. So it'll follow the same pattern. And then perhaps the second one I would think, and this is where James was disseminating between, if you like, complex structures, is there's a big premium on execution certainty. I completely would echo what James said about not being off the shelf. These are very bespoke, and that might be down to the fund structure, the investment structure, tax considerations, the flexibility that you require in terms of, future objectives, and that execution capability, that execution certainty, is certainly something that that gets flagged to us on a regular basis.
Okay, Jonathan, I know this is not necessarily your area of specific expertise, but do you have anything to add?
Yeah, I think the one thing I would add on it, and I'm not going to, delve into the deep end of the pool here with the two gentlemen who do it every single day, but we see from the execution part of it. So when you're done with that line, how do we actually make it happen when you have some very large funds that have a number of different lines, and how they pull on them, and how they make that as efficient as possible. And the other part that we've seen a lot of discussion about from our clients is what we call counterparty health or bank health. Saying in the old days would be wherever I keep my deposits, my balances, I want to know what that bank was up to, what their ratings were, and what their different criteria were. Now it's on the other side as well. Even the ones that we have lines to, I want to see what their health is. Even though they're lending me potentially money, I want to see how they're structured and how safe that line is in the event of something happening. So it's kind of flipped over a little bit. And so counterparty, from whatever type of counterparty, has become more and more important. And then the execution of whether it's moving cash, pulling on a line, how can I do that efficiently with the right controls within an organization, and who's got the ability to actually do that within an organization. So the controls have become really important. So picking up where the lines have been consummated, they're out there. How do I actually make it happen? And what organization, what managed service, what kind of other organization is going to get involved to help make certain that I'm doing it in the right manner that I've laid out in my controls as well. So it's really evolved over the past, I'd say, year or so from that perspective.
Okay. Well, we're running low or almost out of time. So we've got one final question for each of you, right? How do you see the overall fund financing market evolving through the rest of 23 and 24? Let's start with Stephen.
I think you've used the right word, evolve. And it will, the exit environment will remain, challenging. Some of the headwinds that, if you remember 12 months ago, we thought, some of those challenges may have abated slightly by now. They haven't. Will we see a bit more stress in the market, whether it's at the portfolio because of financing costs, macro headwinds, debt maturities, fundraising challenges? There's still plenty ahead of it, but the market will adapt. It will evolve, and whether that's from the lenders, whether it's credit fund, whether it's private equity, participants, it will, because that's what it tends to do. It will be, I think, a period of continued caution. But again, in the meantime, investors, funds, the private equity managers, they'll continue to explore their options across the whole fund finance suite, and those products will develop, and they will start the adoption of these products either for the first time or in a just a much more consistent basis. So evolution is and adoption is definitely the key for me over the next sort of 12 to 18 months.
James, your perspective?
Yeah, evolution and adoption. I think on the NAV front, it's more the adoption of and becoming an asset class over the next couple of years because of the size of the net asset value in the private equity world, and then obviously the continued fundraising going forward, and then the continued use of sublines, for example, will hopefully continue. I think I mentioned earlier, there's this gap, liquidity gap, right? So the way that is starting to be talked about and filled very slowly is through tapping institutional capital to come into the subscription line market to help out the banks. But the issue with them is that they tend not to like revolvers. They like term loan debt, longer term debt. So I think the key is to try and, some managers will look to structure more a subscription line facility as a form of revolver with a term element as well. And I think Fitch is now starting to look at rating sublines which I think will help the banks a bit, because that will mean they don't need to hold as much capital against these type of loans. Right. So I think there'll be an evolution of ratings which will help more institutional, and I think there has to be a shift towards more institutional capital in the subprime market, because the bank market doesn't seem to be keeping up with the pace with it now. And as it comes back, as fundraising comes back and interest rates maybe come off, there has to be more supply for that product.
Great. And Jonathan, you want to give us some parting thoughts?
Yeah, I just think, kind of filling out the end of that is how do we operationalize what everyone has spoken about just now into the infrastructure of an organization, because there's so many different changes and growth. Excel's great, but it can't be the model that they use going forward. And the teams that within a private equity shop that actually handle this need to come up to speed and be able to think about how they actually execute on these things that they put in place. So I think there's going to be more focus on that. I mean, costs have gone up. Will interest rates continue to go up this year? Are we going to get another increase in the U.S. In the coming days? Maybe. Are rates going to go down next year? Maybe. But that just adds to more complexity within the marketplace.
Thank you. Well, I think we're just about out of time. So I want to thank Stephen, Jonathan, and James for your participation. I think this has been great. The session's been full of great insights, and I'm very appreciative of you all sharing your thoughts.